Product lifecycle costing considers all the costs that will be incurred from design to abandonment of a new product and compares these to the revenue that can be generated from selling this product at different target prices throughout the product's life. Okay.
Okay.
This definition is a bit confusing. We'll just break it up. Product lifecycle costing considers all the costs that will be incurred from design to abandonment of a new product. It will consider all the cost from scratch, from zero, from the research and development cost till the abandonment. Abandonment means to cancel that product, to just stop that product. Okay, and compares these.
Okay.
Compares these to the revenue that can be generated from selling the product at different target prices. Then they will be compared with the revenue at what price we can sell at each life cycle point. When we talk about the R&D, when we talk about the scratch, when we talk about the first stage, what would be the price and what would be the revenue from that? Okay, yeah. And the target prices which we'll be setting in different life cycle stages. And then there is a graph that how is it is used. First of all, there is a development stage. Okay, then there is the introduction stage. Here we are developing the product, then this product is introduced in the market. Okay, then there is a growth stage. Now the product is selling more in the market. Okay, then there's a maturity stage when the sales is constant, it is not increasing. Here the sale was increasing, now the sale is stable.
Nothing is stable in the same place.
Yes. Now after that point the sale is declining. Okay, yeah, you can compare
end of the project.
End of the project. Right. Then we have, after decline, the product will abandon. We'll close that product. There are morely technological products which we introduce, like iPhones and mobiles. Then they're first introduced, they are just introduced, people get to know about it, then they grow, the sales is growing, then there is a maturity stage, then this is a decline stage, then they would no would be just buying that product. Okay, yeah. Then we move forward. Now then characteristics of the product lifecycle costing. First stage is the development stage. There is no sales volume. No product is sold. Sales volume is zero. Then what is the cost there? There is only a research and development cost.
Research and development.
Then introduction. At the introduction stage, the volume will be very low. They will not be selling more units. The fixed cost would be very high because we have just introduced the product. We have just invested in it. So the advertising cost, the assets cost, the fixed cost would be very high.
Yeah.
Okay. Then we talk about the growth stage. We just, now the sales is increasing. It is increasing very rapidly. Okay. This will increase our variable cost because the products are sold. So the material cost, labor cost will increase. The variable cost will increase. Some fixed cost will also increase. Like we have to hire one more warehouse or one more machine. So fixed cost can also increase in that. Then there is a maturity stage. Okay, the volume is stable. Now the sales are not increasing.
Yeah.
It is stable. This will only incur variable cost. Okay. Yeah. Then in decline, the demand will fall. The product will be there will be no sales in that. Now this also we will incur only variable cost and some fixed cost as well, which is decommissioning cost. To close that product, we must just dismantle the products. We have to just buy our just sell the warehouse. So this can be decommissioning cost. Okay.
Also, dismantling costs also come here.
Yes, dismantling cost will also come here. It depends on type of product. If the type of the product is like this, that we have to incur some dismantle cost, as there are some chemical factories, and like this, we cannot just close the plant as it is. We have to just fulfill the legal formalities and all. It depends on the type of the product. Then what is the impact of PLC in the modern environment? That if because the products are of now shorter life cycles. Okay, so that's why we have to introduce product life cycle, and there's clear strategic planning required.
Yes.
When we are just launching the product, we must know when this product will go in the growth stage, when they will become mature product, and when it will decline. So we need a clearer strategic planning. That's why PLC is used. Clear it is?
Yeah.
Okay. Then 90% of the cost to be incurred throughout the life cycle will have been determined before a product reaches the market. We have to just know what would be the cost will be incurred in throughout the life. 90% of the cost to be incurred throughout its life cycle will have been determined before the product reaches the market. We must know how and when we have to spend. Okay.
Okay.
Then maximizing return over the product life cycle. Now we are talking about profit. We talk about cost, and now we have to increase our profit. How to maximize the return over the product life cycle? There are a number of ways that return can be increased over the life cycle. First is design cost out of products. Okay. Approximately 70%, 90% of the product life cycle costs are determined by decisions made early in the life cycle at the decision development stage. The design and production team must work together to ensure costs are minimized. When we are designing the product, we must think that how to design that product that cost can be minimized. Okay. How to design that product. If the design is good, so wastage will also be good. If the design is not good, then the wastage will increase. Can you get my point?
Yeah.
Okay. If there is they are making any product like chair, so if you make many variations in the chair, or you have many designs, the wastage will increase. Okay. So if it is a simple design, so it will not increase wastage. So we have to think about how to design that product. Then the second thing is minimize time to market. This is the time from conception of the product is to its launch. If a company can get a product to the marketplace very quickly, it will give the product as long a span as possible without competitors' rival product in the marketplace. This should mean the market share is increased in the long run. Minimize the time to market. If you just do research and development, and spend all the time in the research, so the product will reach the market late. So this will reduce your returns, because till then the competitor product will reach the market. If you are doing the development, your competitor will also be doing the development. So if the competitor product comes early, you come late, so you must have a low market share. Okay.
Okay.
Now the C part, minimize break-even time. Pricing strategies will affect both contribution and volume generated. A short break-even time is very important for liquidity purpose. It is the same point. Just we minimize the break-even time, means we just reach the profitable stage very early. We have to try to bring the product to the profit level very early, so it will just give us good returns, because the product life is short. So if it will go into decline stage, we will not be earning profit. So we have to try to minimize the break-even time of our product. Okay.
Okay.
Then extend the length of the life cycle itself. For example, product development, finding other use of product, or launch the product in different markets. You just try to increase the life cycle of that product. If we just add some feature in the product, so the product life cycle can increase. because people will not be buying that product because it is going towards declining stage. If we add some another feature or anything add on, so this will increase the life cycle of the product and we'll just get a more market share, get more time to be in the market. Is it okay? Can we move further?
Okay. Yeah, can move.
Okay.
Implication of the life.
Implications. Collect data are compared to budget cost. I hope I have not missed any pages. 45. 44. Okay. Now, what are the implications of the life cycle costing? Given that there will be different levels of demand for a product over its expected life, it would not be appropriate to set one price for the product entire life. So when we are pricing the product, we will not be just pricing the product over the entire life. The price will not be fixed. We'll just pricing the product as per the life cycle. The price
You have the different price for the ACCA stage. You have the different price. What does that mean?
It means at the growth stage, when we will just launching the product, the price would be different.
Okay.
And just when we just go towards the maturity stage, the price would be different. And when you are going towards a declining stage, we will just reduce the price because it's a declining stage. No one would be buying the product to be in market to cover up. Yes, you can.
Means that that price to be like go up and coming down.
Sorry, just repeat your point.
Yeah, it means that the price to go up and coming down.
Yes, it depends on the stage. It depends on the stage.
Go from the introduction or from the developing, go to grow in the introduction and grow and mature and to come down to declining.
Yes.
Maybe it's time to come to be zero.
Yes, it can be zero, but will not give products for free. Or
but sometimes
you
like,
can give.
Yeah, sometimes if you that the product is you have the very expenses, you know, like dismantling, like we have worked in the petroleum company. If you have like disposal of the data machine is very heavy, can sometimes give them for free in the site.
Yes, it can be like that.
Yeah.
It can also be like this, that you can increase your price.
Yeah.
And when you are talking about the maturity stage, you just increase your price just to cover everything, and that's move to another market. So this can also be done. Okay. When we were talking about the declining stage, there was another option in that we just add some feature or we move towards new market, because like when we talk about if we are selling something here, it is going toward a declining stage. We can now sell that thing in Sudan. It can just be in another stage, in growth stage, maturity stage in that country. So we can just shift the product to that market. Okay.
Yeah.
Then the implications. Good. Then the implications, there will be different levels of demand for product. Okay. An understanding of the stages a product goes through enables you to price accordingly. To either manipulate low price, demand will rise and the intro stage is shortened, or to maximize profit. We must understand the stages of the product to just price it well. Okay. All costs relating to the product, including R&D, are associated with the product. This enables the assessment of a product profitability. One second. All costs relating to the product, including R&D, associated with the product. This enables true assessment of the product profitability. We must include all the R&D cost as well. Okay. When we'll just studying the relevant cost, the research and development cost is not included in the relevant cost. When we talk about the relevant costing, it is not a relevant cost for that purpose. But here we are saying we have to include this research and development cost in the product as well to just give us true profitability of that product.
Yeah.
Okay. Having looked at a product PLC, it is clear that initially the product will make a loss. Viewing the profitability on a periodic basis can put unnecessary pressure on management due to the visibility of the loss and could lead to wrong decision being taken. If we are looking towards the period cost, because when we launch the phone, for example, we are launching a mobile phone, R&D cost is very high. So if one mobile phone is sold, or 2, 3, 4, 5, or whatever, 100 phones are sold, and the period ends, now we are looking at the profitability of the department. So the profitability will be very low, because we are not reviewing the whole life cycle of the product. We are just looking at the periodic basis. So the management will be pressured, and we can just stop that product. But this product can give us profit after some time, because it has to cover its cost first. Then it will make profit for us. Okay.
Okay.
So life cycle costing can make you do a better decision. Then what is the advantage of that life cycle costing? It considers external factors. Okay, the stages of the product are the external factors. So it considers that. It also considers all the cost. R&D cost is also R&D cost is also accumulated to that product. Then very useful in modern competitive environment. It is very useful when we are talking about a modern competitive environment. Okay. Now there is a question. We just go through the question and we'll just look at the answer. Company X and high-tech industry are often first to market with new technological advances. They have recently spent $5 lakh in designing and developing a new product. The new product is expected to have an 18-month life cycle. The life cycle of the product is 18 months. Okay. Then the anticipated performance of the product as follows. Sales volume at the introduction stage will selling 4,000, then growth 9,000, maturity 30,000, decline 10,000. Selling price 599, 49, 449, 349. Variable cost 249, 249, 199, 149. Overhead 100, 100, 60, 75. Calculate the profitability of the new product. Let's go towards the answer. Solution, whatever you can say. Then we are just calculating what is the revenue. When we talk about the revenue, its revenue is increasing in the maturity stage, then the decline stage, it has fallen down. Okay. Now variable cost. Sorry.
How to increase that one?
Because the units have increased now. In the maturity state, we have sold 30,000 units.
Yeah.
Okay. Then the variable cost is also increasing, and at the declining stage, because the volume has gone down, so the variable cost is also less. Then development cost, we have 500. Okay. 500 minus then 1,000 is our profit. Then it is 1,800. Then this is 5,700, and this 1,250.
Yeah.
Okay. Then the total cost when we are talking about it is 9,250. This is a total cost.
Yeah.
Okay. Yeah. Whether price variances are occurring. So when we talk about the price, we have just we have made the fixed price, right? We have a selling price different, or we have a fixed price?
Different.
We have different selling price now. 1 second. Selling price is 599, 549, 449, and 349. Yes. So selling price is different. And now we analyze that what is our profit. When we just look at the revenue is 2396 at the introduction stage. Okay. And our variable cost is 996. Okay. And the overhead is 400. Okay. Just we will not just including the introduction at introduction stage, we will not be subtracting the development cost.
Yeah.
Okay. In the introduction stage, we have got a profit of 1000. Then the growth stage we have 1800, and the maturity we have 5700, and the decline stage we are earning 1250.
Yeah.
Okay. Just when we look at if the total picture, we are in a profit position of 9250.
Yeah.
Okay. So we will just, if we have to analyze a product, we analyze like that in the life cycle costing. Okay.
Yeah.
We just look at the product at different stages. At the end of the day, we have a profit. It means we have priced the product well, and we have accumulated the cost as well. So that's why we are in profit. Okay.
Okay.
I can move forward.
Yeah.
Then there is a past paper for it. Just we'll read it out. Companies operating in an advanced manufacturing environment are finding that about 90% of the product lifecycle cost is determined by decision made early in the cycle. We just studied it, that it is good. We will be knowing every cost of our product at the beginning of the research stage, beginning of the project, right? The management accounting system should therefore be developed that aid to planning and control of product lifecycle cost and monitor spending at early stages of the life cycle. Okay. So this is a term we just studied. Now
40 now 40 can make new video now to 40.
Yes, I'm just sharing it. Okay. Once again.
Sorry for the disturbing.
No, this is okay.